Hey everyone, this is Robert Keens at goldsilverpros.com. It is Thursday, October 15th, 2020, and much to the excitement of many of my subscribers, I'm going to get back to looking at the Comex today and the gold and silver prices after having spent about a week on the government digital ledger systems and cryptocurrencies. We're going to come back to the gold market, so let's go ahead and get started with that. We're going to start off by looking, of course, at the current gold price. It's up about $7 today, 1907. Good to see it above its all-time high in 2011. That I'm going to show you today why I don't think that we're in a bear market for gold, even though we fell down from the 2050, 2060 range that we reached previously. And silver is bumping right up against resistance at 24.50. It's sitting at 24.29 today. We're going to take a look at silver as well. We're going to get into the physical delivery so far in the month of October and what that tells us about the market. And we're going to get in some exciting news that came out from the Fed as to what they're going to do to support the treasury markets. It's going to be very, very interesting. We'll get started by looking at the gold market, and what we see here is that we've had some pullback or retracement, if you will, in the gold price, but we've had a nice little bounce up here recently to get it back above 1900, back above this previous support line from 2011. This is an all-important support line, and it looks like it will probably stay there. I'm going to show you why I think that's the case. Wanted to point out before I get into the short chart and we look at the last month or so of action. Here is a curved line I drew showing from the point of when gold started to rebound in late 2018. Remember, we had that 20% stock market correction after Powell tried to tighten, the Fed tried to tighten on their easing and raise interest rates a little bit. We started to have a bear market in the stocks, and then gold started to recover at that point, reacting to the news. People started flooding in. So we started this nice little curve line here. Pay attention to this green line because it's going to come into play when we look at the short-term chart, because it has become a demarcation of support, as we can see here. This is the green line. This is that upward sloping curve from late 2018 when gold started to recover from its bear market since 2011. And we had, as a matter of fact, a couple of days ago, gold bounced right off of that little line, signifying that we're not in a bear market. We have not come down below this trend dating back to Q4 of 2018. We did come back through back here on the 21st of September. We did come back through the 50-day moving average, is shown by this blue line. We actually came back through this critical support line of 1900. It fell down and then retested this 1900 line, fell back down to this curve line, or this trend line dating back to Q4 of 2018, and it came right off. So could it come back down through that trend line to fall back down maybe to the 200-day moving average, or the 50-day moving, the 200-day moving average, come back and signify that we're actually in a bear leg of the market, or maybe just a steep correction is probably the better way to put it. It could come back down. Let's see, the 200-day moving average is right here at 1754.67 on the chart. So it could come back down to 1754, but I think it's key that it bounced off this curvature line that I drew dating back to late 2018, meaning that the market does not see us being in any sort of bear move for gold, at least for right now. This is acting as support. Now, if we see the gold price come back down through this, if it hits 1900 again and retest this critical support line, then maybe we're going to continue to come down and form the handle to that cup and handle I've been talking about. For those of you who maybe just started following the channel, a cup and handle formation is extremely bullish for any asset trading, whether it be a stock or the precious metals. Here's the cup formation forming over a 7-year time frame. The handle is when you have this nice little recovery back to previous highs, and then it falls back down. This is a correction, normal healthy correction, when people sell at the tops, and then you have consolidation here in the market and people come in to start buying, and then you have another move up. I'm looking for that potentially to happen. If it does, it's probably going to come back to about the 200-day moving average before it moves up again. But again, looking at this chart, we're going to go back to the short-term chart. We have bounced off temporarily this trend line dating back from 2018 when we started to get back into the bull market for gold. So as long as it stays above this mark, it continues to just barely move up and stay above that mark, we're probably not going to have that handle form on the cup and handle formation on the longer term chart. We'll see what happens, but it's very interesting. It literally bounced right off of that line. I saw that. I was like, oh my goodness, people are trading that line. They're trading the trend dating back to late 2018. Now, this is just technical trading. Doesn't mean that there's not going to be more bearish sentiment or a correction or profit taking, if you will, in the gold market. But it'll be interesting to see what happens. I wanted to look at what's happening in the volumes or on the CME Group's website on the gold volume. You can see that, again, we're having a healthy number of deliveries as compared to the open interest numbers, the closed open interest and the total open interest. So that means that there are a lot of deliveries relative to the paper trading going on a daily basis. And we started seeing that when we talked to Kieran Von Hest a few weeks ago, maybe a month ago. His data showed that was happening dating back to the spring, and that coincided with a lot of the economic lockdowns and the supply chain problems we had. I mean, that people were coming on the Comex to get gold. We've also seen that gold is flowing from London into the Comex market to get gold and silver probably as well. So it looks as though a lot of deliveries are happening on Comex, and that's how people are sourcing their gold and silver. And we continue to see that in the daily numbers on the October contract. Lots of deliveries here, what we previously have called spot delivery or same month delivery, or we've called shadow contracts, meaning people are coming in, they're establishing a contract, they're taking delivery within a few days in the same month to get that metal off the market. This indicates that some people are in a rush to get that gold, potentially because they see shortages in the actual physical amounts available for trading on the Comex, or they just want to source a gold because they can't get it elsewhere. We'll continue to watch that. We're seeing this big buildup in December of contracts. So last time I did a video on this, we were just above 400,000. I want to say we're like 403, 404, somewhere like that. Now we have 442,000 contracts of open interest. That's 100 ounce gold. That's a very healthy number. The volume alone was 188,000 traded for the 14th of October, which is yesterday's data. That is an immense amount. And you can see here, we've had some healthy volume numbers shown here on the chart. Now, nothing like we saw at the end of September, but again, we're in the middle of October. We tend to see, as the month goes on, some very healthy paper trading and also now physical deliveries occurring in the metals. Let's go to the metal issues report. This is the month-to-date delivery notices for the physical metal off of Comex. We started off with a bang, and I did a video on this right after this 6,000 number occurred at the very end of September, I believe, 6,000 contracts. We followed that up with another 5,000, then 4,000, 2,900, but you've seen these daily totals in this column stay healthy throughout the month. Now, yesterday was only 181, but still we're seeing almost 2,000 to 3,000 throughout the month. So we're now at 31,488 contracts. Let's look at the year to date, and the pattern that I showed you the last time we did a video. This is gold, Comex 100 gold futures. I said since the beginning of the year, we've had a small month of deliveries and a big month, a small month, a big month, and the smaller months are getting slightly bigger, even though they're small months. So then we had a quote unquote small month in May, a really big month in June, then it died down a little bit for July, then a really big August, then it slowed down a little bit in September, then a really big October. So that pattern has emerged. Every 2 months, we're having really big delivery months so far the year. Now, if that pattern holds at the end of the year, you should see massive, massive deliveries in December. Why? We'll just look at the open interest, 442,000. Now in October, we've had 30-something thousand contracts delivered, physical contracts delivered, when we don't have that much open interest in gold to begin with. I think rolling over from September, something like 3,000 and something contracts. If I remember, I have to go back and look at the data. We've had 30,000 delivered for the month, 31,000 delivered. So just a massive amount of deliveries going on a relatively thinly traded month here in October. If that pattern holds true and we continue to have this every other month increasing delivery, you know, are we going to get 40, 50,000 contracts in December? One would certainly think so. Now, people could close out of their December positions, roll to a new month, or cash settlement between now and December. We'll have about a month and a half till that happens, till they can start taking delivery on that December contract. But just the sheer volume of that open interest that we see here in the December contract makes it look really interesting for gold. And another really interesting thing that we're seeing is we're seeing some open interest start to open up in February, which will be the next delivery month in gold after December. April, and June all have really healthy numbers. This is not abnormal for the gold market where you have a peak. It's kind of like a bell curve, if you will. You'll have the nearest delivery month will be fairly heavy in volume, and then you'll start to see that peter off into further months. But 48,000 in February is still a pretty big amount. People are taking bets on the price of gold, several months out. And not only that, but when we see these kind of deliveries occur in thinly traded months, it makes me think that we're going to have a healthy amount of deliveries going all the way through June of next year. So in the next 6 to 7 to 8 months, I would continue, based on current trends, continue to expect to have more gold deliveries occur, with December being, the pop-off month. If we're going to have, a massive amount of physical deliveries, one would expect to be in December based upon the open interest. We'll see between now and then if this open interest increases, decreases, and we'll see at the very end of November when that first delivery date occurs, that intent notice day occurs, if we're going to think we're going to have a big December month when those first delivery notices come in. I wanted to go to the COT charts now. Now I'm on bar chart site because it basically aggregates all the commitment of traders data together. For those of you just now starting to follow the channel, commitment of traders gives you basically these big four categories of traders: the producers and the merchants. The producers produce the gold and silver out of the ground, in this case gold, because we're looking at the gold chart. The merchants are in this category as well. They're the ones that use the gold to actually produce goods, usually jewelers, but there are some technology companies like computer manufacturers that use gold. The swap dealers are the bullion banks. They're the ones that either have a depository and or have big trading accounts where they take orders for other people, and they aggregate all those orders up into their account, and also do some trading for their own house accounts on the metals markets. Then you have the managed money, which are the hedge funds, the financial types, and the other reportables are like the trust funds, big family offices, the wealthy individuals. A very interesting trend in gold here as we go along throughout the year. This yellow line, which is the wealthy individuals, the trusts, and those types of family offices, they've increased their longs. Now, when you're increasing your long, that means you're typically, as a percentage of that, going to take some physical delivery. Not only are you going along the paper market, but you're going to take more physical delivery. So the longest group right now, the other reportables in gold leading into December. Now, this could change between now and December. We've got about 6 weeks. But I'm expecting that the wealthy families are going to start to take more gold off the market. And this has done nothing but increase since about June of this year, where they've taken over the lead position from the managed money. Now, the managed money typically doesn't take delivery. They're in there for price exposure because they think the price is going to go up, so they'll take a long position. They usually don't take delivery. So the main group that looks like they're taking delivery is going to be the other reportables: wealthy individuals, trust funds, those types of entities on the Comex. Now, the swap dealers would take it. They're net short about, what is that, 200,000 contracts or so. Let's see. The swap deal, 189,000, as you can see in this yellow box up here to the left, 189,336 short, but they do have long positions. So what they typically would do, what we'll see they'll do is they'll put in a bunch of short positions. They'll have less long positions. They'll take delivery on some of those long positions and take metal off the market. You can see that in the depository statistics. So just because they're net short doesn't mean they can't utilize a long contract to take physical delivery while they're holding all that short paper. So all the short paper, what that does when you have a lot of short paper come in the market, that holds down prices for all these people that want to take delivery. It looks like the other reportables are going to take delivery. It looks like some of the swap dealers, the bullion banks, are going to do it. In this red line, the producers, they've come up almost to zero. They actually have, let's see, they have negative 97,000 contracts shorting gold. They're shorting that because of price exposure. If gold falls and they're producing it, they go short the market to make money on the price fall, to make up for the fact that they're going to be selling gold at a cheaper price later. That's basically hedging. So a lot of these short contracts, the red here, is legitimate price hedging by the producers. So that's basically how you read the COT report in gold. Again, it looks like wealthy individuals, trust funds, family offices are going to be taking most of the delivery for the rest of October and leading up to December, if this trend doesn't change, as we see in the commitment traders for gold. So that's gold. Now we'll get into silver. We're going to do both metals, so it's going to be a little bit of a long report today, but I wanted to get you guys both reports since I haven't done one of these Comex reports in a little while. So let's get both of them in. Here we have the long-term chart in silver. We've had this price pullback, or what I like to call a retracement, from about $29 back in the, was it late July timeframe? I think when we saw all those physical deliveries come in from Comex, we saw the price spike. Now we've had this retracement and a bounce back up. this line has been the most critical since July in determining where silver is going to trade. This 24.50 mark I drew on the line. Now that was support and resistance from when we had the last bear leg after the 2011 high in silver of around 49.50 bucks. This became one of the key lines to look at in 22 also, because you can see some price points here supporting this resistance line or support line, depending on which way the price is moving. The 24.50 has been a key one here. Now, silver has fallen down through the 50-day moving average. You can see that by this blue line here. You can see the 50 days in blue, the 200s in red over here. So, but it hasn't fallen anywhere near the 200-day moving average. So again, we're not in a bear market in silver either. If anybody says we are, they really don't know what they're talking about. You really have to pierce down through that 200-day moving average to officially call a bear leg. We've seen silver come back down through the 200-day moving average, back down through this critical support at about 24.50. And we see that it's retried 24.50 a couple of times. The third time it came back through, but it fell back down below. But the fact that we came 3 times through that 24 resistance line means that the next time it challenges 24.50, we could see it pop through and stay above it. That happens a lot when you see it challenge 2 and 3 times. The third or the fourth time it challenges that resistance line, a lot of times it'll come back through. Now, we don't have a lot of volume going on in silver right now in terms of the paper trades. So that means really the longs and shorts are kind of battling it out. We've seen modest physical deliveries. We'll get to that here in a moment. But really, to really call the next big phase of the silver market, the next big, maybe March through 30 bucks, I want to see it both come through the 24.50 line and come through this 50-day moving average. By the time it pierces 50-day moving average, probably going to be somewhere around high 25s, low 26s. If it goes through there, then I think we're going to have a very bullish move in silver. But again, not a lot of deliveries in gold and silver expected for November. So we could see some sideways action in the metals unless we have a big news event. Presidential election, definitely November could affect that. So let's talk about what could happen to gold and silver in November. We've got the presidential election. That could have a big effect on the precious metals. And then the next big event that would have an effect would be those December deliveries, because that's the next big delivery month that we see in both metals. Those are the next 2 events. So around the first week of November and around the very last couple of days of November, when we start to see those delivery notices come in for December month, is probably the 2 big catalysts for what's going to happen in the precious metals. So we'll pay attention to those and we'll offer you guys coverage when that occurs. Now we're going to look at the volume for silver from the CME Group. This is Wednesday, October 14th data. Same thing we see in gold, 129,000 open interest for the December contract. Not a lot left for October and November. We did see a few deliveries in silver, and as silver hasn't been as strong delivery in October as gold has been, although these are 5,000 ounce contracts, so a healthy amount of contract or of physical ounce delivery. But again, setting up for December, and then in March, we're skipping January, and then in March, we're looking at another potential big delivery month in silver. So again, the next 4 to 5 months for silver lining up, we'll see what happens in the deliveries. Overall volume, again, down here, as we can see. We're going to go to the COT report and see what's going on for the commitment of traders in silver. Just like gold, we're going to look at the producers and merchants, the swap dealers, managed money, and the other reportables. The producers, the red line, they're going a little bit more short silver than they've been pretty much at any point in this year, with the exception of March when we first had the shutdowns occur. They went really sort of short silver, expecting silver to fall, and it did. It fell down to something like $11 or $12 at that time. So they're going net short again. A lot of people thinking maybe the silver price could fall between now and December, which, since November is not shaping up to be a big delivery month, that's probably, a safe bet. So they're hedging their price risk. The producers are. The swap dealers have gone net short slightly in silver, but they're almost at zero. So that number actually is sitting right at the swap dealers negative 7,000 contracts. Nothing really to speak of. That's about even. So just slightly negative there. Again, the interesting thing, we're seeing the other reportables. The other reportables, this yellow category, remember, the rich individuals, family offices, trusts, things like that, they're coming up and going long in silver. So I expect them to take healthy deliveries in silver for the rest of October and especially in December. You can see this line creeping up since about August timeframe. They're taking long positions in both gold and silver. I expect wealthy individuals, trust funds, family offices, and things like that to take delivery of the metals. Clearly, we have wealthy individuals and offices going to the metals. A lot of uncertainty with the election, a lot of uncertainty with the economic numbers we've had this year due to economic shutdowns and some of the deflation we've seen in the production statistics. So it seems like the well-to-do, the well-heeled people and small companies are going long the metals. That's what that tells me. And again, the management, the financial types have reduced their long position a little bit. Again, they're just in there for price exposure. They're not taking physical delivery. And the swap dealers, like I said, basically net zero, slightly short on silver. Not a lot to talk about there. If we go to the metal issue report for silver, we'll get down to that. We had somewhat healthy deliveries the first delivery notice day for October, and then it's kind of fallen off. We just had 24 on the 12th and then 12 and 13. So again, silver was not a big delivery month for October. Most of those contracts have rolled to December. It's probably we'll continue to see a lot of deliveries for silver. Let's go down and look at the annual numbers for silver. The 5,000 ounce silver contract, a similar pattern emerging. We have fairly big month, a small month, fairly big month, a small month, really big month, a small month, another really big month, a small month. So, and I think it's going to skip November because I don't think we're going to see a lot of deliveries here. And then I think we're going to see deliveries in December if that pattern holds every other month or so on those silver deliveries. So again, expecting a lot of delivery for December, nothing new. I've been preaching about it here for a couple of months, but we've had healthy metal deliveries in both gold and silver, for October, considering it was a fairly thinly traded month. Let's go back to the silver. We didn't have a lot of contracts in October, but there've been a fair amount of delivery. So given that fact, in December and maybe even in carrying over to March, we should have physical deliveries in silver there as well. And again, it looks to be the rich individuals taking it off the market along with some of the bullion banks, putting it into their accounts. And what I also want to do is go to the physical report. So here's the gold report, the metal depository statistics. We can see the metal move into and out of the Comex depositories on a daily basis. This is for the 14th, as you can see on the activity date here, printed today, but for yesterday's data. Of interest in gold, we're on the gold report, as you can see here. There were 32,119 contracts worth of gold delivered to Brink straight into register that did not come from eligible. So it wasn't from the warehouse stocks. It was straight off of the market. And we had 14,000 in JP Morgan come up from eligible to register. In this case, JP Morgan's probably expecting to deliver that many ounces of gold on their futures contracts. That's why it probably came from eligible. Same thing with Brinks. They brought it from off the market for a net total of about 46,000 more contracts and registered. Again, when you see numbers go up and registered, this is a positive number day over day. You're expecting more deliveries coming up either in the current month of October or even more so they're building up their stocks for December. And again, the last time we checked gold, this was a 36 million number. Now it's 37 million of total in registered and eligible. And this number I think has come up from, gosh, I want to say last time I looked at it was 13 to 14. So a lot of registered gold being made available for trading, I think, leading up to December. That's why I expect to have more deliveries. When you see these come into the registered category on the Comex depositories, we're expecting more deliveries. That's sort of front running what we think the actual deliverable contracts are going to be in the next coming months. So in this case, it would be December. Here's the silver report, same day, yesterday's data printed today. Again, it brings 189,000 ounces of silver came into registered inventories, not from eligible, so off market. Here we had International Depository Services of Delaware moved 593,000 ounces from eligible to registered. So that was from their existing stocks on Comex. We had 596,000 move into Loomis International, only eligible, not for delivery. And total, we had about 782,000 ounces of silver move into registered in addition. Now we have a healthy 138 million ounces of silver available for delivery, another 243,000 ineligible, 243 million ineligible. How much of that eligible will be available for delivery to move into this registered category? We don't really know. But in any case, it looks like there's a healthy amount of gold and silver on the Comex for future trading. We show this in previous videos. In 2019, there was not a lot of metal movement from London to the Comex, but in 2020, we're starting to see metal movement from London to Comex. So whatever that free gold was available in the London market seems to be coming to Comex, and people are taking it off the market. And remember who's doing it. It's going to be the other reportables, wealthy individuals, trusts, so on and so forth. And some of the swap dealers are taking the metal off of the Comex exchange. So that is the metal report for today. And I wanted to give you guys a bit of news. It's something I saw on Zero Hedge that I think is extremely interesting. The title is Fed Vice Chair Makes Shocking Admission. The Fed may never be able to stop manipulating the market. Now we're talking about the treasury market and the debt markets in general, and how much money gets pumped into the stock market and those types of things. So it says here, yesterday, San Fran Fed President Mary Daly made a stunning admission. Just in case there's any confusion, the Fed knows that it has and continues to blow an asset bubble, but the economy is now so reliant on the Fed liquidity fire hose that the moment the Fed threatened to pop this bubble, it would result in economic devastation. Here's a quote from this gentleman here in the picture. I'm not willing to trade millions of jobs for people who need a ladder rung up in order to keep the stock market from going up for a few who have those holdings. In other words, what they're saying is we're not willing to crash, or we're not willing to crash the stock market because it's going to wreck a bunch of jobs. So they're going to continue to pump the stock market. They're going to continue to keep the easing policy in place for the markets. And they've admitted this. They really have never admitted this blatantly before, even though we knew that was what was going on. And that's a stunning admission. So what Zero Hedge says here, and I agree with them, in short, there's no longer a market. They're only centrally planned transactions, which can only happen with the explicit blessing of the Fed, which can pull its backstops and whim and crash trillions in assets. So the flip side of this argument is if they do pull liquidity, it could crash the stock markets and potentially the treasury market as well. So they have to keep pumping it up. And they're using the excuse of they don't want to lose millions of jobs because that's one of their mandates is employment. So they're using that as an excuse, but really they're pumping the markets, trying to keep the markets up. And that's going on. He says here, or would there be some indefinite need for the Fed to provide, not as a way of supporting the issue in treasury, but as a way of supporting functioning market and treasury, participate as purchase some period of time. So in other words, what is also being said here is they're going to purchase treasuries. They're going to monetize treasuries directly. It doesn't mean some other country's buying them or individual investors are buying them or funds are buying them. The Fed's going to start monetizing treasuries directly. Of course, we know they've been doing that. So they're not only supporting the stock market, they're supporting the treasury market. And this is a blatant admission by the Fed in their own words, in testimony. What a lot of us have been saying for 10 years since the last crash, and some people saying it even before that, certainly Peter Schiff was saying it since the mid 2000s. I've been saying it for 11 years now. They basically come out and admitted that that's what they've been doing. So all the people that thought that that was a conspiracy theory, that's not what the Fed was doing. Well, they're admitting to doing it, whether they were blatantly doing it before or they just feel like they have to do it now to maintain the status quo of the markets. 6 of one, half a dozen another. It doesn't really matter. The fact is they've admitted to doing it. They're going to continue to do it. I think long-term that's bullish for the metals. I think it will continue to cause people, especially rich and well-informed individuals, as we saw on the COT charts, to continue to take delivery of the precious metals. For you guys out there, that are a retail investor, if you haven't made your decision on precious metals, I think there's a lot of data showing why we think there's going to continue to be a bull market in the precious metals, both from a fundamental reason in terms of what the Fed is doing in the treasury and the stock markets, but also what we see in the trade data and we see in the technical charts as well. We're not entering a bear market for gold and silver. They can still continue to retrace some without us going into a bear market, but I think they're going to bounce off somewhere in November, December, and we're going to continue that next leg up. I think that's what's going to happen. Could be wrong. We'll stay tuned to it and see what happens as we go forward. But seems like all the variables are aligning for us to continue to move up in the gold and silver. I'm going to wait to really make any strong trend predictions until we start to see that delivery data for the December contracts. And then I'll come back in and I'll say where I think it's going. Of course, we'll have the election behind us, and that will tell us a lot about risk on, risk off in the market as well, and how the Fed's going to react with their monetary policy based upon who's elected. If the Democrats get elected, New Green Deal, universal basic income, that would tend to be very bearish on the paper markets, very bullish on the metals markets. We'll see what happens there. We'll continue to cover it. This is a long video, guys. Wanted to give you a really juicy one for today since I haven't covered this in a while. I'm going to come back and do some more of this next week as well. And I'm going to continue the state-issued Fed coin, crypto, whatever you want to call it, central bank digital currencies, whatever name you want to give it, discussion next week as well. I've got more data for you from the European Union and what they're doing, showing that this trend towards state-issued central bank digital currencies is spreading across the world. It's not just in the US. So we're going to continue to cover that topic as well next week. So stay tuned to that. Till next time, this is Robert Keens with goldsilverpros.com.